And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. That's right, it's Thursday. Get ready to wrap up this week, first week of December, and which also means bad news is you've got 2 weeks till Christmas. So if you haven't started your shopping yet, better start now, because as I told you before, if you know that overnight delivery thing from Amazon, it's like, we'll deliver overnight. It'll be 3 days. It'll get here. So don't forget to get your stuff ordered soon. All right, so a couple of things to talk about this morning. ISM Services came in yesterday much weaker than expected. Now, the important part about that is that ISM Services makes up about 80% of the economy. So I know we pay a lot of attention to ISM manufacturing because it has a large multiplier effect in the economy because of the manufacturing process itself. But that's only about 20% of the economy. Services are a much bigger driver of the overall economy today versus where we were back in, say, the 1970s when it was inverted. But what was interesting yesterday is we did see a big drop in that ISM Services number. It went from 55 to 52. We saw drops in employment as well as orders, etc. So again, definitely some weakness in that number. And again, if you take a look at that ISM Services Index, it's really just been kind of bouncing in a downtrend now for a while, and continues to show that there's still some economic weakness, kind of overall in the economy. So despite, the fact we've got a booming stock market and earnings are doing great from companies, there's certainly some economic weakness there as well. And of course, we're seeing that also in, kind of pickups in the unemployment rate a bit. We're starting to see some data in the job openings survey where we're seeing, a decline in the number of job openings. So definitely some weakness in the economy as we head into next year. And again, this isn't surprising. Something that Mike and I have talked about a lot in the past is that all that money, all that stimulus that we put into the economy from the IRA Act, the CHIPS Act, etc., that's all been working its way through. And so now that we don't have a lot of new influx of new money into the economy from government spending, we're starting to see the effects of that lag effect that's been lagging for a long time now is beginning to kind of show up in the economy, in kind of small bits and pieces, but definitely starting to see that show up here. Outside of that, though, again, the overall data continues to be okay. Again, and with the ISM Services Index, it's still in expansion territory. It's not in contraction, but definitely showing some signs of weakness. But overall, the market continues to do okay. Earnings are continuing to come in as expected. The one thing that we're going to talk about, in this weekend's newsletter is about expectations for next year. Expectations for earnings next year are at $253 a share according to S&P. That is a 19% increase in earnings for next year from where we are from 2024. So again, that's a lot. And historically, earnings grow at about 7% on average every year. So you're talking about a really outsized increase in earnings per share for companies. But this has been a function of a lot of exuberance. Over the last 2 years, markets have had 2 years in a row now of over 20% gains. But interestingly enough, earnings for 2024, here's a good example of this. When we were in 2023 looking at 2024 earnings, expectations were that earnings would grow at 15%. They grew at 9%. So here we are again looking at 19% growth in earnings. Big expectation will be is that earnings are going to grow somewhere probably high single digits next year if the economy doesn't falter on any level. But particularly starting to see now that we're seeing earnings begin to slow down here a bit, it's certainly worth paying attention to the risk of the valuations that we're currently paying on a forward basis for stocks that we're investing in, because earnings are going to very unlikely be able to meet the expectations that are currently laid out there right now. So just keep that in mind. Okay, here's what you need to know before the bell this morning. Big news, of course, overnight is that Bitcoin hit 100,000. This is the kind of the level it's been flirting with now for the last really kind of month. Lots of headlines like, will Bitcoin make it above 100,000? Yesterday, Trump appointed a new head for the SEC. Of course, Gary Gensler will be stepping down from the SEC before the inauguration. He's the chairman of the SEC. So Donald Trump appointed a new head for the SEC who's very pro-crypto friendly. That got everybody very excited. Crypto broke out of that 100,000 range, currently trading about 102,000 right now. So again, just a continued move here on a lot of excitement. Really, starting back, we were at 60,000 back in October. Right, so now we're at 102,000. So again, after a very, very long consolidation in Bitcoin, this is, we talk a lot about technical analysis and portfolios, etc. And one of the things that you look for in technical analysis are long periods of consolidation where something just doesn't go anywhere. And this can be a stock, it can be anything that you're looking at, but you get a long period of consolidation like this. This works off a lot of previous overbought conditions, kind of gets a negative bias put into, whatever the asset is. And then eventually you break out of that consolidation, and that gives you kind of a launch pad for a bigger move. And that's what's happened here since October. We had that very long consolidation, lasted, basically from March to October, broke out of that. And so we've had a nice technical move. But again, as we've talked about before, be a little bit cautious here. We've got very big deviations from long-term moving averages. Bitcoin is overbought and currently, at a very elevated level on a momentum basis. Again, doesn't mean that it can't go higher. I'm not saying that at all. But again, this is kind of one of those areas where eventually you're going to get a pullback, as is always the case. If you think Bitcoin's going to go to 200,000, that may very well be the case. It's just not going to go straight there without a pullback along the way. So again, if there's something that you're in, this is a good time to take a little bit of profit, kind of rebalance your risk a bit. You get a pullback to support levels. Buy some more. It's completely okay. But again, just kind of something to think about. Again, a lot of just exuberance around cryptocurrencies right now, particularly since the election, because a lot of the things that Trump has been doing has been appointing people that may bring a bit more favor in terms of an asset class to Bitcoin in terms of the overall financial markets. Outside of that, though, technology also had a big breakout yesterday after a good long consolidation, and again, lots of headlines. And this is always the great thing about headlines, right? Headlines for the last several months have been, technology's dead, AI trade is over, and again, who wants to be in AI stocks, right? I don't know. But anyway, yesterday we had a very nice breakout of technology to a new high after a nice long consolidation since that yen carry trade blow up earlier this year. So again, these are the types of things. The market's very optimistic right now, very bullish at the moment. We continue to move asset prices higher, see money flows coming in. We've had some of the largest inflows into equities on record in just the last couple of months. So we've had a very, very big move in asset prices over the last 2 months. That's been driven a lot by foreign inflows as well as retail inflows, and professional inflows have been very, very elevated across boards. And particularly we're seeing this not just in actual equities, we're seeing massive inflows into ETFs and particularly leveraged ETFs. We're seeing a lot of speculative investing right now in the markets across the board, particularly on the leverage side, where investors are wanting to take on more risk to be invested in the markets right now. Again, very optimistic outlooks across the board, but again, that does contain a lot of risk. So again, it's just as we continue to talk about higher asset prices, and again, the bull market remains intact, we're going to be higher into the end of the year most likely, probably have some bumps along the way, but higher into year end, but continue to manage risk, rebalance accordingly, manage your portfolios you need. That's what you need to know before the bell this morning. We come back, special in-guest studio this morning, Michael Lebowitz. We're going to talk about volatility and lots of other stuff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Save the date now for the RIA 2025 Economic Summit, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Lebowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Watch for registration details at realinvestmentadvice.com. Save the date now for the RIA 2025 Economic Summit, Saturday, January 18th. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
And good morning. Welcome to the show. Of course, live in studio today, Michael Lebowitz. How are you doing?
Good.
Yeah.
Good to be in Houston.
Yeah.
Nice and toasty warm here.
Versus, how cold was it when you left?
30s.
Jeez. I think we're being in the 60s today.
But last night I was at the hotel sitting at the bar watching a game, and the guy next to me was from Minnesota. He was talking about wind chill temperatures minus 20, minus 30.
Yeah.
All of a sudden, plus 30 sounded pretty good.
Yeah. I was watching the news the other day, and they're talking about Michigan, and they get that lake effect, and just they're all having to snow plow driveways and everything else. I'm like, yeah, that's why I live in Texas. So
did you see the Bills game the other day?
Yeah.
I'm not shoveling out a seat.
There's a limit to my sports fandom, which is when I have to shovel out a seat.
Especially at $150, $200 ticket. That seat's going to be shoveled for me.
Exactly. All right. Well, we got a few things to get into this morning. Mike's in town today. We have a event tonight at Republic Boot Company here in Houston. So he's here to visit with some clients today, and it's great to have him here live in studio so we can talk about some things. 49ers are toast, by the way, according to chat. But, so one of the things that Mike has been writing a little bit about lately, and again, there's a lot of concern right now, is like, when's the next crash coming? When's this going to happen? And again, kind of a lot of bearish comments, but the markets continue to just perform very bullishly right now. And it's kind of interesting, we get a lot of questions. It's like, well, what's your outlook for a year from now? It doesn't really matter what my outlook is 12 months from now, because the markets are going to be different. The economy is going to be different. Things are going to happen. And so trying to guess anything more than just, a month or two ahead is really kind of just for folly. And this is why you get these 2025 outlooks, right? As everybody's like, well, market's going to be at 7,000 next year. Nobody knows. We can go back to 2021 as a good example. Wall Street, Goldman had expected a 15% increase in the market in 2021, and the market was down nearly 20 in 2022. So, I mean, it's great. People want to have these outlooks. They want to have something to kind of hang their hat on. But at the end of the day, you just have to manage the markets for what they are and what they give you, and navigate kind of the twists and turns that go away. But there are certainly things that we can be watching that are certainly can pose a risk to markets. Now, it doesn't mean that risk will come to fruition, but there are certainly things that occur that can impact markets if something happens, right? We can talk about the Silicon Valley Bank crisis, right? Interest rates were going up. It was impairing their collateral. We could see that occurring, and we said, okay, there's a risk there, for the markets, and of course it did, right? And we had that event back in 2019. Mike and I were writing numerous articles talking about the Fed overnight lending, and we were seeing repo rates spiking up. And Mike had written an article talking about, you're borrowing money on a guaranteed asset, right? U.S. Treasuries, and people are charging you 10% interest overnight. It just doesn't make a lot of sense. There was certainly stress in the markets, and we could see something was going on. But those are the things that you want to kind of watch for, these events that impact a specific area of the market, and that is liquidity. And Mike just wrote an article about this on Wednesday. It's on the website right now. If you want to go take a look at it, we're going to kind of walk through it this morning. But liquidity is the one thing that despite all the other stuff, right? We have people talk about, the debt and the deficit, or the economy, whatever it is. Those are all kind of byproducts of the one thing that really drives the market, which is liquidity.
Right. Liquidity is money. Liquidity is how much money does the market have? Do the financial markets have? And it drives everything. Just like it drives how much you consume. It's based on your paycheck. How much can you borrow? How much can you use on credit card? It's all liquidity. Lance starts every morning with technicals. Well, technicals, what they're really measuring are sentiment and liquidity. It's kind of a different way of looking at that, and it's something we focus on heavily. We also focus on fundamentals, but they tend to be longer-term predictors of markets. But, at the end of the day, the reason the Dow's up slightly today, was up a lot yesterday, is because of liquidity and sentiment. It's not because price to earnings were this or price to sales were that. It's because of liquidity and sentiment. So I wanted to revisit liquidity because there are a couple, it's not horrendous, but there's a couple clouds on the horizon that bear watching. For one, at the last quarter end, we saw repo rates. So what's repo? Repo is where you borrow money overnight. Overnight repos, where you borrow money overnight, but it's collateralized. So I give Lance $1,100,000 of treasuries, and he gives me $1 million for the night. The next day, I give him back his $1 million. He gives me back my treasuries. Everything's good. If I don't pay him, he keeps my treasuries, cashes them out, and then gives me whatever's left over. So Lance is in a great position, and there's no reason he would ever need to charge a rate above the going market rate. Last quarter end, we saw some of those rates spike, and that's because at quarter ends, liquidity becomes scarce. Banks have to protect their balance sheet because they report on a quarterly basis, and it's somewhat common, but the rate that they spiked was much higher than normal. And we saw some minor spikes throughout the quarter, and even recently. The other thing is that the Fed dumped isn't even the word, just put a tremendous amount of liquidity into the markets during COVID. They put in way too much. And had they done nothing about it, interest rates, at least short-term interest rates, would have been minus 2, 3, 4%. And they didn't want that. They have their Fed funds rate. And what they do is they manage the money markets to the Fed funds rate. And the Fed funds rate was, 0 to a quarter, I believe. Yep. So they had to take that liquidity out. And they they have a reverse repo program, RRP, which basically says, give us your liquidity. And it basically reverses the process and takes the liquidity out of the market so that Fed funds and short-term rates all trade where they want them to trade. And that was very effective. But that program, which peaked at about 2.6, 2.7 trillion, is down to 200 billion. And what that represents is the excess liquidity in the market. So it's this bank of liquidity. And it's great because it's still 200, 150, I think the last was 150 billion. Chart's already a little outdated in the article. But what it is, it's a bank of liquidity. And as long as that bank is there, liquidity should not be too big of an issue, maybe at quarter ends.
Right.
But that bank could be gone in a week.
Let me show this chart that you have in your article, because this goes back to what you and I were talking about back in 2019. And I think it's a good point to revisit, is that in 2019 we were writing these articles like there's this kind of weird stress that's going on in underlying markets, and what and those things typically occur when there's a lack of liquidity in the market, there's stress somewhere, and those typically turn out to lead to some type of market correction at some point. And it's always interesting because if you listen to a lot of the financial markets, they go, oh, well, there's no way you could have told that you would have known that 2020 was going to happen, but yet there was a lot of indicators that the market was under stress, and all it took was something, some catalyst to get the sell going. And in fact, in January and February, we were reducing our portfolio positions because just technically the market was so extended, so stretched. It's like we're going to have a correction of some part. We don't know what's going to cause it. And then, of course, it was the COVID crisis. So, but again, there was this evidence that something was going on. You can see this in the chart in 2019. Heading into 2020, that this overnight kind of repo was just going crazy, and Mike basically was using the example that this is akin to you going to my house and parking a brand new Mercedes in my driveway and saying, here's the keys for the collateral, and kind of borrow a little bit of money overnight. It's like, sure, no problem. But this is what was going on, and the rates that were being charged were 8%, 9%, 10% for overnight lending, and again, to Mike's point, that should have never happened. And we're starting to see, and it's not showing up on the chart yet, but we are starting to see some of those potential stresses.
And what's amazing about that chart is you can see 2007-8 there.
Yeah.
And it's, 3 times as much? The banking system was collapsing in 2007-8. You can make a case that in 2020, there were some big issues.
Right.
But in 2019, there were not big
Right.
issues like the banking system collapsing. In fact, the banking system was relatively healthy at that point.
And again, I mean, even if can you bring that chart up real quick one more time? So, and if you look at this chart, you can see this little spike in 2022. That was the Silicon Valley bank crisis. That little bump. So when banks are failing, we didn't have near the crisis that was going on liquidity that we saw in 2019. But again, this is why we watch liquidity, because we talked about last week. I wrote an article about credit spreads, and if you take a look at Treasury to junk bond credit spreads, it's got a great track record of giving you kind of an early warning sign that, hey, we need to start being more cautious with equity investments, those type of things. This type of liquidity analysis is the same thing. So, while people are running around waving their arms, talking about, the debt and the deficit, it's not a problem until it shows up in liquidity.
Right. And you'll start seeing signs in the market in some of these Fed programs. You'll see there's other places. Fed funds will get a little jumpy, especially at month end, quarter end, and those are things that we need to pay attention to. There's no crisis now, and there's no crisis tomorrow, but things are starting to bubble up a little bit.
There's some signs.
Nascent.
Nascent signs. So they say there's green shoots. So what is it when you have this? Is it brown shoots?
Red shoots.
Red shoots. Okay. Bamboo shoots.
Look at the graph.
There you go. All right. Quick break. We're going to come back. Got some more stuff to get into. Don't go away.
Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Save the date now for the RIA 2025 Economic Summit featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Lebowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Watch for registration details at realinvestmentadvice.com. Save the date now for the RIA 2025 Economic Summit. Saturday, January 18th. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife put up Christmas lights this weekend, so she's very excited now. But she's very upset at the same time, Brent.
Why is this?
She ordered another Christmas tree for the house. Showed up at the house, she set it up, she goes, honey, this tree's not big enough. We need another one. We'll have one on one side of the fireplace and one on the other. And I'm like, no, we're not. One tree.
The Real Investment Show podcast. Same show, your schedule.
Needless to say, I slept on the couch this weekend
at realinvestmentadvice.com.
The saga of Christmas trees in my household.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So lots of, along with this conversation about liquidity in the markets, and there's in the financial markets, regardless of the headlines, it all comes down to liquidity. If you have a lot of liquidity, markets are going to go up. If you have an extraction of liquidity, markets are going to go down. That's just the way it works. Right now, we have a ton of liquidity coming into the markets. As I was saying during the opening of the show, you take a look at inflows into the markets. We have record equity inflows into the financial markets. We have record levels of assets being dumped into leveraged ETFs. And this is at levels well beyond previous peaks in the market. Talk about FOMO, or the fear of missing out. We have that going on right now. There is a fear of missing out in the markets, and that can last for a whole lot longer than you think. Yes, valuations are elevated on a forward basis. Valuations are elevated on a trailing basis, but that can last for quite some time because of just people chasing assets.
Let me break in for 1 second?
Sure.
Because I think this is what a lot of people don't realize. Most of us as individuals, we're called retail in the business. We have $100,000 in the bank, and we can buy about $100,000 worth of stocks or bonds or whatever it is, Bitcoin, whatever it is we want to buy. Most institutions have $1 million in the bank, and they'll buy 3 to 4 million or more of assets. There is an incredible amount of leverage in the markets. And that leverage, which is supporting asset prices, is heavily dependent on these overnight markets, on interest rate swap markets, which I'm going to write about in a couple of weeks. And there are these markets that no one follows, that it doesn't affect you or me as investors, but those institutions that have huge amounts of leverage, it greatly affects them. They pay close attention. And when they start to see signs, they know they got one of two ways to fix their leverage problem. They can either pay the higher price, like when Lance was talking about the Mercedes at 10%, they can pay 10%, or they can sell assets and reduce their leverage. So, bear in mind that leverage is dependent on liquidity. And leverage is the reason leverage is the reason that markets are where they're at, where
Right.
Bitcoin is where it's at, everything. So.
Well, and again, and when you talk about leverage, immediately people tend to think about margin debt, right? And so if you go look at the margin debt on the New York Stock Exchange, which is the margin debt that's on brokerage accounts, right? It's like, oh, well, that's not gone up that much. Well, the problem is that there's a ton of leverage in the market currently that's not measured by something like margin debt, because again, you have all these people that are now piling into these leveraged ETFs, whether it's a 2-for-1 or a 3-for-1 S&P index, or it's a 2-for-1 or 3-for-1 NVIDIA ETF. We just have a massive surge in the issuance of these leveraged ETFs. So you have a lot of leverage in those assets. Then you have leverage through other means as well. So again, we have a lot of people chasing one-day options, right? These what we call zero-day options. The options expire unless that's leverage, because I'm leveraging my money through options. And then again, to what Mike's talking about is that if I'm a bank or a major institution, a hedge fund, I don't use margin debt. I can, as measured by the New York Stock Exchange, I leverage through my bank. And I have $1 million, and then I can leverage that up 3, 4, 5 times through my margin lines at the bank. That's not represented by the New York Stock Exchange. So again, there's all this leverage in the system that you don't see in some of the measures of leverage and what's going on in the markets.
Right. So again, we can talk till we're blue in the face about fundamentals.
Right.
But if there's a ton of money, a ton of liquidity in the market supporting leverage, asset prices are going to rise. Mm-hmm. And conversely, if some of that leverage falls away, it can tumble quickly, because again, it's levered 3 to 1, 5 to 1, 10 to 1. So it's falling at a much quicker rate than it would be if you or I were to sell our 1-to-1 shares.
Yeah. Well, again, this was back in August. This was the whole yen carry trade blow up, which is, again, that's a prime example of what you're talking about.
That's another leverage trade.
Right. That's a prime example of that. I basically buy Japanese JGBs, the Japanese government bond, and then I basically leverage that 10 times. I buy $1 million worth of those bonds, and I leverage those 10 times to buy U.S. stocks, and I catch the spread. So that's more leverage that we don't see. But you saw the impact of that when the value of the yen went up too much. We saw that unwinding occur all in one day, and the markets are down 8.5%, like that. That's going to happen. At some point, that leverage will reverse, and that's where you're going to get this bigger downtick in the markets. But again, you're not going to probably see it coming until after the fact.
Here's another stat for you. The interest rate swap markets, which again I'm going to talk about in an article in the coming weeks, is
so excited, can't wait.
It's a sleeper. I'm going to tell you right now, it's a sleeper, but it is one of the bedrocks that every asset price is sitting on. That market is twice the size of the global stock market, global bond market combined.
Wow.
Think about that.
Yep.
That's a market no one knows about. No one knows where interest rate swap spreads. No one knows what interest rate swap spreads are. Mm-hmm. So it's something that we are going to write about and put you to sleep about, but inform you. So that,
exactly. You'll be asleep, but you'll be informed.
And you can use it at your cocktail parties.
Yeah, and that's why I produce so many charts. I take those to cocktail parties. Those are great talking points.
Everyone,
right?
all my friends love this stuff.
Love the charts. Yeah.
Right.
I want to talk about something real quick. Shift gears, because it's not really shifting gears. Kind of the same thing. You know, there's a lot of concern going into next year that interest rates are going to go up, bond prices are going to go down. You know, the one thing that you have to remember, and again, there's, you know, a lot of the thesis next year is that interest rates are going to go up because of tariffs, and tariffs are going to create inflation. Mike and I both just wrote articles just recently on the website. If you go to the website, go to the search bar, put in tariffs. There's 2 articles we just wrote about how tariffs really don't relay to inflation. But the one thing that a lot of people kind of waving their arms and going, oh, interest rates are going to the moon, you know, this is the 70s. You have to remember right now is that the Fed is still reducing their treasury debt. In Mike's article, he's got a really good chart. He's got a really good chart on the Fed balance sheet. One of the things that's going on right now is that you have $1.9 trillion more of bonds in the market than you did back in 2022, and that's because the Fed's been reducing their balance sheet. So at some point, if interest rates begin to rise to a level that start to impair the banks, and again, the Fed says they have 2 mandates. They say their mandate is financial stability and full employment. That's what they say their mandates are. Their real mandate is to protect the banks because that's their members. Their members of the Federal Reserve are the major banks. It's JP Morgan, it's Goldman Sachs, it's also the financial stability of the entire economy is based upon the stability of those banks. If, again, we saw what happened when Lehman went under, can you imagine if JP Morgan, Bank of America, and Wells Fargo all go under at the same time? That's your 1929 scenario. That's what happened in 1929 that led to the Depression. The banks failed. The Fed's job is to ensure that doesn't happen. So at some point, if interest rates rise to a level that begins to seriously impair the functioning of the banks, they will turn QE back on and start buying bonds to lower interest rates.
And that's kind of the meat of the article per se, is that the Fed is not the only source of liquidity, but they are a large source of liquidity through their repo programs, which we discussed. There's still some liquidity in that bank of reverse repo, but it's coming down quickly. Mm-hmm. And at the same time, there's liquidity in the Fed operations via QE, QT. But like, you know, it shows on that graph, QT has reduced the Fed's balance sheet by 1.9 trillion or so. And that 1.9 trillion now resides on other balance sheets that require leverage. So liquidity is leaking. Here's the big thing is, though, and there's some graphs on reserves, there's some graphs on our liquidity monitor, and they all look fine. Here's the problem is we don't know how many assets they're supporting. We do know that speculation has been very high. With that, leverage tends to increase. So what we don't know is how many reserves, how much leverage is needed to support asset prices at current levels. What happens when that reverse repo program goes away, when the bank of excess liquidity is gone? And I don't have an answer for you, but I do know that at some point when the Fed senses there's a liquidity problem, and believe me, there's a big red phone on Powell's desk from Jamie Dimon and from the CEO of Citi and Wells Fargo and all the other big banks. When they see slight problems in liquidity, that's their first call. Right. So it's kind of a scary thing because liquidity is failing. The Fed's going to have to do things, but it's also a time you can be opportunistic because the Fed is ultimately going to flood the market with liquidity to support asset prices.
You know, it's funny you said about the big red phone. So back in the the late 80s, after I graduated college, I was managing a CD book for a bank. And one of our customers was a pretty large bank in San Antonio. And I had to go they had a bunch of CDs with us. I had to go have a meeting with them. And he does have a phone to the Fed, but it's not a red phone. It's a satellite phone because the banks are required to be in communication with the Federal Reserve at any time. So there cannot be, like if the communication system goes down or whatever, they have to be able to contact the Fed. So they all have satellite phones.
Right.
And I was like, that's pretty cool.
No, that doesn't surprise. I mean, the Fed.
This is back in the 80s.
Fed
right?
knows everything going on.
Oh, yeah, absolutely. And if you ever think the Fed's going to let things get out of control, and this is why the Fed has done such a job of trying to prevent another type of financial crisis. That's why they acted so quickly in 2020. Why they acted so quickly with the Silicon Valley Bank crisis. They are not going to let another 2008 happen again anytime soon. They just can't afford to. All right, be right back after the break. Get ready to wrap up the show with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Save the date now for the RIA 2025 Economic Summit, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Lebowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Watch for registration details at realinvestmentadvice.com. Save the date now for the RIA 2025 Economic Summit, Saturday, January 18th. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Lebowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right. All right, welcome back to the show. Michael Lebowitz live in studio today. You guys in chat are funny. So let's talk a little bit about Mike. Let's just talk a little bit about the market again. Getting ready to wrap up the year here. Mike's struggling with his headphones.
Having a technical
he's having technical issues with his headphones over here. You should throw the camera over and watch this.
This is why I do this at home. I got it. Yeah, got it. Okay, I'm leaving. Back to Maryland.
What are you gonna? It's gonna be interesting to see what happens in Maryland. So if Elon Musk and Vivek get their way with Doji and they start shuttering entire branches of the government or moving branches of government to Kansas City or Wyoming, what's going to happen to Maryland? Because a big chunk of the Maryland revenue comes from Washington, D.C.
It's going to be a disaster.
Yeah.
I mean, all the lobbyists, all the just government workers, all the defense contractors, that would shatter the local economy. New York too. There's a lot of cities that if the government were to really move and cut, it would really have that's the thing. That's what makes it so hard. It sounds great that he wants to cut the government, but the economy is being driven by the government.
Oh yeah,
by the massive spending. So, we all want the government to cut, but if Trump really has his way and does what he wants to do, it could be an ugly couple years economically before we become much more efficient and better.
Well, yeah, but here's the problem. Can you bring up this chart for me? I posted this chart on X this morning. That this is the percentage of the debt, this is the percentage of spending as a percentage of GDP between entitlement and non-discretionary spending, right? So entitlement spending, you can't cut, right? That's what we call, so our government budget has two facets to it. There's mandatory and discretionary. Mandatory is exactly what it says. It has to be paid. That's the interest on the debt, your entitlements, that's welfare, Medicare, Medicaid, the Affordable Care Act is in there, prescription drug benefits, veterans benefits. Those must be paid. The military must be paid. Everybody else, all this other stuff, this Department of Education, the Department of Transportation, all that can be cut, but it's a very small percentage of the overall spending as a percentage of the budget, and it's also a very small percentage of spending relative to GDP. So if you're wanting to get GDP down, you're not debt to GDP down. There's not a lot of room to cut. I mean, you'll be able to reduce it some. You could probably trim, $1 trillion, and I'm not saying that's not left pocket change by any stretch of the imagination, but you're not going to be able to get a $2 trillion deficit most likely back to a budget surplus just through non-discretionary spending cuts.
Right. And I keep looking at graphs like that, and Elon Musk really has a tough task in front of him. Some of that discretionary spending he will be able to cut, and he may be even some of the entitlements, maybe they can get some stuff through Congress that reduces it a little. But there's one big fat pot of money that they can reduce, and that's the interest expense. There's $600 billion now. 1.1 trillion in interest expense being paid out this year.
And how would you cut the interest expense?
Raise interest rates? No. Maybe cut interest rates. So bottom line is, if you can bring interest rates back down, and I'm not saying back down to zero, but down significantly, you can cut $400 or $500 billion right off the bat. You don't need to talk to a lobbyist. You don't need to talk to a bank. You don't need to go to Congress. You don't need to do anything. Somehow you got to get interest rates down.
And that could be, let's see, the Fed could cut interest rates,
QE.
Or they could start doing QE.
Our new Treasury Secretary can play games, Operation Twist type games. There's options. Obviously, if inflation is running hot, it's going to be harder to do. But if inflation all of a sudden weren't running so hot, if the economy was slipping, rates could drop pretty quickly and solve at least that problem that Trump's facing. There's other issues, but but it would bring the deficit down nicely in a very short period of time, and he can do his mission accomplished pretty quickly as compared to many of the other tasks that he's trying to take on. So it's just something to think about, that cutting this deficit is going to be very difficult, and I don't think they really, Elon Musk especially, who has never really been in Congress, doesn't appreciate, or in government, doesn't really appreciate the task, and the lobbyists. Forget the Democrats, from the Republican side. Everything's fine when you want to cut, but don't cut in my state. And that's going to be the problem on both sides of the aisle.
Right, exactly. But let's talk a little bit about the markets, because again, we're getting ready to wrap up the year here, and we're starting to talk about next year, and there's a lot of moving pieces going on next year, and a lot of things we really don't know what the impacts are going to be. We don't know. This is a good example. We don't know if Trump's new administration is going to be able to cut spending as much as they want. Will they be able to cut it at all? But there's impacts from that. We really don't know what the impacts will be on tariffs. We can look back at history and say this is what was done historically, but we don't know how they're going to be implemented, when they're going to be implemented, on what goods are going to be implemented on, et cetera. We have lots of broad brush strokes ideas, but this is going to be one of the kind of the challenges going into 2025. Yes, everybody's very bullish on the markets. Outlooks are very bullish on the markets. Earnings expectations are extremely optimistic on the markets, but all that's ultimately dependent on economic growth. And every economist right now, and this is always my one concern, is when every single economist is bullish on something, everybody agrees on one thing, something else tends to happen. It's Bob Farrell's rule number 9. And I think we're moving into an environment of a lot of potential uncertainty because we don't know how these policies are going to unfold. We don't know if they're going to unfold the way we think they are, what kind of pushback that Trump's going to get from Congress, even from Republicans that are more on the kind of the historical rhinos, right? We don't know how much cooperation they're going to give him. Right. So I think there's a real risk next year that earnings don't come to fruition as much as everybody expects, and we could see a good pickup in volatility next year. After 2 years of 20% returns, you just almost have to expect you're going to have a year of more volatility.
Right. It's funny. Everyone is most bullish at the top and most bearish at the bottom.
Yeah.
Unlike
except Adam, he's always bearish. So,
unlike as consumers, we're most willing to buy something the cheaper the price goes. 20, 30, 40% off, I'm in. Right. That's what Black Friday's all about. Mm-hmm. 40%, I'm buying all I can buy off, right? But with stocks, I got to sell. I got to get out. There's this panic that spreads, and this incredible sentiment that also spreads at the top of bull markets. And it's very difficult going into a new president who does have some novel ideas and does things differently than we're kind of used to, even compared to his last term. So I think the market's going to be apprehensive. But what's funny is, when you go from December 31st to January 1st, nothing's really changing. It's not like there's this whole new environment that's put into place. So whatever's going to happen happens over time. And it doesn't mean that because we get into January, we got to really manage our risk and we got to sell everything and we got to just go to cash and see what's going to happen. It just means we have to continue, and we're paying close attention now. Continue to pay close attention to everything going on politically, every liquidity, like we talked about earlier, sentiment. Is it changing? How are the markets holding up? Is breadth good? Is it bad? Is breadth confirming the highs, or are there signs, technical signs, that it's weakening underneath? What sectors are leading? What sectors are lagging? What factors are driving the market? And those are all things that, there's a million little puzzle pieces, but when you put them together, you can get a halfway decent picture of what the market is, and then you can form expectations of what may or may not come and start. Doesn't mean that even if we put this puzzle together and it's pretty bearish, that we sell immediately. What it does mean is that we have our bearish radars on, and we're probably a little more aggressively on the sell side than the buy side. But we're going to continue to take what the market's telling us, digest it, and figure out how to put it to best use, managing risk, managing reward. That's what our jobs are all about, risk and reward.
Well, it is, and this is, again, this is always kind of the thing that I do discuss a lot with Adam. It's like, you can have these big macro views about whatever it is that you want to have the macro view about. I think the debt and the deficit is going to lead to an economic collapse, or I think the bull market's going to last forever. Whatever your macro view is, your macro thesis is, that's great. The problem is the market's going to do a whole lot of stuff in between. And our job is simply, and your job as investors, our job is to manage money for our clients and try to protect them against downturns and help them make money and help them grow their wealth, for retirement. That's our job. Your job as an investor is to make sure you're growing your wealth. And focusing on these big macro views tends to detract from your ability to manage your money effectively. Focus on the short term. We can control the short term. We really have no control over the long term, because the long term is impacted by so many variables that we absolutely have no control over, or any knowledge that they're even coming. Because again, the thing that gets you is always the unexpected exogenous event that no one was expecting, like a pandemic.
Expect the unexpected.
Exactly. It's what we don't know that we don't know that we do know that we don't know, right? So whatever it was.
Something like that.
Something like that. All right, wrap up show for the day. We will see you back here on Monday. We have this event tonight, so Danny and Richard are going to sleep in the morning, apparently. They're too lazy to get up after an event. I don't know what's going on. Anyway, we'll be back on Monday with our next live show. Have a great weekend. We'll see you then.